Australia has just shaken the foundations of global finance in a way few could have imagined. In a move that caught analysts off guard, Fortescue, one of the world's largest iron ore producers, borrowed nearly $2 billion, not in U.S. currency but in Chinese yuan, and did so on terms usually reserved for governments. Almost immediately after, Australia's Treasury issued its first yuan-denominated bond, and the Reserve Bank shifted a quarter of its foreign reserves into China's currency. The International Monetary Fund called it unprecedented. No advanced economy has ever moved so aggressively to align itself with the yuan. If America's closest Pacific ally is already financing its future through Beijing, one question now looms large. How much longer can the US dollar maintain its dominance before the cracks begin to widen? In August 2025, Fortescue announced a syndicated loan worth 14.2 billion yuan, roughly 1.98 billion US dollars, arranged by two of China's biggest state-owned banks. This marked the first time in history an Australian corporation borrowed such a large amount directly in Chinese currency. What shocked observers wasn't just the scale, but the rate. Fortescue locked in borrowing costs near 3.8%, nearly identical to what the Australian government itself pays on 5-year bonds. A private mining company securing sovereign-level borrowing terms was almost unheard of. Fortescue later confirmed it had achieved its lowest cost of debt in company history. This wasn't a one-off transaction. It was the clearest signal yet that something much larger was taking shape. Earlier that same year, Fortescue's ambitions in America began to unravel. Its $550 million hydrogen project in Arizona was derailed by shifting regulations and political uncertainty. By mid-year, the project was shut down entirely, forcing the company to take a major write-down. Disillusioned by the volatility of U.S. policy, Fortescue quietly began looking elsewhere, to China, where financial and regulatory systems appeared more stable and predictable. That decision wasn't just opportunistic, it was strategic. China already buys more than 80% of Fortescue's iron ore exports. By borrowing in yuan, Fortescue matched its debt with its revenue stream, effectively shielding itself from exchange rate risk. The new financing was also tied to its green transition, including major equipment purchases for its green steel operations from Chinese manufacturers. In doing so, Fortescue created a fully integrated financial loop, borrowing, procurement, and repayment all conducted in yuan. Beijing was no longer just Fortescue's biggest customer. It was becoming its banker, its supplier, and its strategic partner. What began as a single corporate transaction quickly rippled through the system. Australian regulators discreetly amended banking rules to allow yuan-denominated syndicated loans in Sydney. That legal shift made the Fortescue deal possible. And, well, it really paved the way for others to follow. Within a year, the share of Australian exports to China invoiced in yuan jumped from just 3% to 14%. Economists estimate that continued adoption could save the country up to $20 billion annually in foreign exchange management costs. At the same time, banks began adjusting. ANZ introduced yuan clearing services for corporate clients, giving Australian businesses direct access to Chinese transactions. The People's Bank of China went a step further, cutting clearing fees for yuan payments to a fraction of dollar transaction costs, a move clearly designed to accelerate adoption. In one of the most dramatic changes in modern financial history, the Reserve Bank of Australia increased its yuan holdings from 5% to 25% in just 12 months. Such a large reserve reallocation is almost unheard of among developed economies. This was more than a symbolic gesture. It was a structural shift in national monetary strategy. Analysts called it a financial realignment that may now be irreversible. What began as a corporate experiment was rapidly becoming official policy. Across the Asia-Pacific, central banks have been quietly increasing their yuan reserves, but none as quickly as Australia. Regional holdings of China's currency have grown by roughly 40% year on year, yet Australia's pivot has been faster, deeper, and far more visible. This speed has raised questions among policymakers. If a U.S. ally multiplies its yuan reserves fivefold in under 2 years, what does that mean for its ability to access U.S. dollar liquidity during crises? Analysts at major think tanks have warned that Australia's diversification, while prudent on paper, could weaken the very safety nets it once relied upon from Washington. In Washington, this shift has not gone unnoticed. Leaked diplomatic communications revealed that U.S. officials are closely monitoring yuan bond activity in Sydney, and viewing it not as harmless diversification, but as a potential strategic drift. Australia insists that diversification is a form of insurance, not alignment. But to U.S. policymakers, the optics suggest something more consequential: a subtle but significant tilt in regional loyalties, expressed through economics rather than politics. Meanwhile, the yuan's presence inside Australia is expanding rapidly. Regulators have begun drafting guidelines to help domestic banks manage yuan clearing accounts, effectively embedding Chinese currency into Australia's financial system. The country's sovereign wealth fund, the Future Fund, announced that up to 10% of its assets could soon be held in yuan. Major pension funds followed suit, launching yuan-denominated infrastructure debt vehicles tied to projects co-financed with Chinese partners. By mid-2025, roughly 80% of Chinese direct investment in Australia was already settled in yuan. Currency trading data shows the daily turnover between the Australian dollar and the yuan doubling within months, while volatility against the US dollar began to decline. For markets, the signal was clear. The yuan was no longer an outsider. It was becoming a stabilizing force. The fiscal impact has been immediate. Yuan-based borrowing is estimated to have cut Australia's national debt servicing costs by more than 200 million Australian dollars in 2025 alone. Major corporations are following Fortescue's lead. The Port of Newcastle completed its first yuan-settled coal shipment to Guangdong. BHP, the world's largest mining company, signed an agreement with the Bank of China to explore yuan financing for future copper projects. And the Australian Stock Exchange confirmed plans to list yuan-denominated bonds, allowing companies to raise Chinese capital directly without using the US dollar as an intermediary. Globally, yuan bond issuance has surged over 30% in the first half of 2025, with Australia now seen as one of the most important new markets driving that expansion. The Treasury has formally integrated yuan borrowing into its sovereign funding strategy, a historic first. If this pace continues, analysts predict that the US dollar's share of Australia's reserves could fall below 40% within just 2 years. What began with a single mining loan has evolved into a nationwide financial transformation. Australia is not merely experimenting with an alternative currency. It is rewiring its economic foundations. The question is no longer if the US dollar's dominance will erode, but how soon. More than $50 billion worth of trade between Australia and China has already been settled in yuan, a figure that once took years to reach. This shift is no longer theoretical. It is happening in boardrooms, banks, and government balance sheets across the country. In hindsight, this may be remembered as the moment a developed Western nation quietly redrew the financial map, not through politics, but through the practical calculus of economics. The era of unquestioned dollar dominance in Australia may not be ending overnight, but the trajectory is clear, and it's accelerating faster than anyone expected.